On September 15, 2008, $639 billion disappeared overnight as Lehman Brothers declared bankruptcy, sending shockwaves through global markets. The seeds of this catastrophe were sown in the early 2000s when cheap credit and loose lending practices fueled a burgeoning housing bubble. Homeowners indulged in speculation, banking on ever-rising property values. Financial institutions, driven by an insatiable greed, engineered complex securities based on these shaky foundations, creating a precarious edifice that would soon come crashing down. The dawn of the 21st century brought a period of unprecedented growth in housing prices. From 2000 to 2006, the U.S. housing market saw prices soar by over 85%, driven by easy access to mortgages. The dream of homeownership was aggressively marketed to millions, irrespective of their ability to repay these loans. Banks, keen to capitalize on the boom, issued risky subprime mortgages to individuals with poor credit histories. These high-risk loans were then bundled into mortgage-backed securities, MBS, sold to investors as safe, high-return investments. By August 2007, the facade started to crack. BNP Paribas, a major French bank, announced it could not value its holdings in subprime mortgage-backed securities, citing a complete evaporation of liquidity in the market. This announcement sent the first tremors of an impending crisis through the global financial system. The financial world watched nervously, but the worst was yet to come. March 2008 marked a pivotal moment with the collapse of Bear Stearns, a leading investment bank that had heavily invested in subprime mortgages. Facing a liquidity crisis, Bear Stearns was hurriedly sold to J.P. Morgan Chase for a mere $2 per share, a fraction of its value just a year earlier. It was a harbinger of the chaos to unfold. The financial sector was akin to a house of cards, teetering on the brink of disaster. Wall Street was in denial, but the foundations were crumbling beneath their feet. By September 2008, the financial world was in freefall. Lehman Brothers, one of the most storied names on Wall Street, with a history dating back to 1850, filed for bankruptcy, triggering widespread panic. The illusion of invincibility that surrounded Wall Street firms shattered. The Dow Jones Industrial Average plummeted, eventually falling 53% from its peak in October 2007. The world watched in horror as the global financial system teetered on the edge of collapse. In the eye of the storm stood figures like Richard Fuld, CEO of Lehman Brothers, whose reckless risk-taking led to the firm's downfall. Fuld, once hailed as the gorilla of Wall Street, became a symbol of the excesses and hubris that defined the era. Meanwhile, Henry Paulson, the U.S. Treasury Secretary, orchestrated a series of unprecedented bailouts to prevent a complete meltdown of the financial system. Under his leadership, the Troubled Asset Relief Program, TARP, was implemented, injecting $700 billion into the banking system to stabilize it. The crisis exposed Alan Greenspan's laissez-faire regulatory approach as a catastrophic oversight, highlighting the dangers of deregulation in the financial sector. The human cost was staggering. The Great Recession, as it came to be known, led to the loss of approximately 8.7 million jobs, doubling the unemployment rate from 5% in 2007 to a peak of 10% in 2009. Families across America faced foreclosure, with an estimated 10 million people losing their homes. The crisis wasn't just numbers on a screen. It was lives turned upside down, dreams shattered, and futures put on hold. In communities across the nation, the sight of abandoned homes and shuttered businesses became all too common, a stark reminder of the economic havoc wreaked by Wall Street's excesses. In the aftermath, the U.S. government enacted the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010, aimed at curbing the excesses of Wall Street and preventing another financial calamity. It was a belated attempt to impose accountability and prevent a recurrence. The act introduced significant changes, including the establishment of the Consumer Financial Protection Bureau, CFPB, to safeguard consumers, and the Volcker Rule, which restricted banks from making certain kinds of speculative investments. But despite these measures, the scars remain. etched deeply into the economic landscape. The crisis starkly highlighted the need for stringent oversight in financial markets and the perils of unchecked ambition. A bubble built on greed, subprime loans disguised as AAA investments, and dangerous oversight gaps led to one of the darkest chapters in financial history. The 2008 financial crisis serves as a chilling lesson on the perils of unchecked ambition. It reminds us that behind every statistic lies a human story of loss and resilience. Families who lost their homes, retirees whose savings evaporated, and young graduates facing a barren job market all bore the brunt of a system gone awry. As we reflect on this catastrophic event, it's crucial to remember that the interconnectedness of global economies means that a failure in one part can ripple across the world. The lesson is clear. Sound financial practices and vigilant oversight are non-negotiable to safeguard our future. The crisis underscored the importance of transparency, accountability, and ethical conduct in financial institutions. It taught us that the pursuit of profit should never come at the expense of stability and trust. In commemorating this dark chapter, we honor not only the lessons learned but also the resilience of those who endured its harshest impacts. As we move forward, let us strive to build a financial system that upholds the principles of integrity and responsibility, ensuring that such a collapse never happens again.